Hi, this is Randy Finney with Right Side of the Chart, and this is a early to mid-session update for Tuesday, January 7th, 2025. It's 10:50 a.m. Eastern Time as I'm starting the video, so we're not quite halfway through the trading session yet. Just want to go over miscellaneous, a little potpourri mix of trade ideas, quick update on the markets. I answered a question today that I think is worth repeating. I did so in the comment section. You could check it out. Somebody asked what defines active trading. How often do you active trade? That varies tremendously depending on market conditions. You can almost look at the VIX, and I can almost look at the VIX and tell you when. When the VIX is elevated, when volatility is high, think back in that sell-off, but in leading into the August 5th lows. Think back, go back in time, COVID, the bear market back in or the big bear trend back in late 2021 to late 2022. Things like that. You have periods where you have extreme movements, and it's usually in those corrective mode periods, but not always, that you get the biggest moves, and it goes in both directions. Remember that in bear markets, the biggest single day gains, and you can look this up. I've been doing this a long time. The biggest single day gains almost always come in a bear market. So you get oversold conditions, extreme short covering rallies, and all this stuff. Things move fast. In other words, trading a correction or bear market is just like trading a bull market, but with the fast forward button on your TV. You hit the 2 or 3 or 4 times playbacks or fast forward speed. That's what it's like. You just have to be quicker. In a bull market, you can be late getting out or late getting in. And when you're shorting or trading, bear market or correction, you got to be Johnny on the spot. And that's what I try to do here. You got to, get in quick enough when something breaks down. If you wait 2-3 days, in my opinion, you've missed the opportunity. It's no longer objective if you're far way below your breakdown point. Likewise, especially at the lows, we did that back on August 5th. Sent out something in the morning pre-market, covering all shorts, going in hard long. And if you just waited a day or two, that was in pre-market and was even below where the crosshairs, where that candle is that day. Futures down even lower. Again, all the reasons were cited. There was 101. I couldn't think of a single reason not to do that. And you can see it was an explosive rally. So if you just waited, in 2 weeks, the bulk of the gain was made. It was a 15% 2-week rally, and it didn't let you in or let you out if you were short and wanted to cover. So again, market conditions. Now I'm going to speak to this real quick. Somebody asked, okay, what is active trading? Again, depends on market conditions. Went into the holidays, late December. I posted on the 60-minute chart the bullish falling wedge pattern. Where is it? 15-minute chart actually, and gave you a long setup here. These divergent lows. It was one big divergent low. Gained that rally, had that yesterday, showed you hitting my maximum price target, reversing there, going short. And so that was a 1-week trade from about average, the entry buy points from here to here, about 1 week in a 1-day short, and then cover that and trade along. I'm still long right now. I think we'll get a little bit more out of this. I'm not completely sold on it. The market's starting to wobble at the very least. And now let me talk on that real quick. Let's go out to a daily chart. Okay, what do I mean by the market being active, conducive to active trading? That's what I stated heading into the end of the year. Told you that's what I would be doing, more so than swing trading. Again, it's experience, gut feel, intuition, chart reading. But if you look at the recent move, this is QQQ. These are obviously candlesticks. You can see we've gone nowhere. So if you are frustrated, welcome to the club. If you're a swing trader or an investor, because you've gone absolutely nowhere now for weeks, even back here, we're trading today, right now, where we're at. If I put a crosshair, exactly where we were back in the beginning of November. And we're not much higher than we were at the peak there in July. Okay, but if you look at the ups and downs, and just kind of visualize or measure it out, measure these little micro trends. This is what I've been in active trading mode. This is active trading. This is swing trading. We swung that down. We did it, and I posted for active trading to, we were short right at the highs. There was that bearish engulfing candle there. We covered with impunity at the lows, hard reversal. That's swing trading right there. That was a multi-week drop. followed by a, again, if you want to say, at least the initial pop, and that's all, I was looking for at that time, multi-week rally. So this is typical swing trading. This is active trading, and you can see this is really a grinding market. There's not a lot of opportunity. I can get nitty gritty, and I do, and it's not for everybody here. I go down to the 5-minute charts, sometimes 1-minute charts, try to eke out a 0.5%, a 1/4% on NQs or whatever I'm trading. And if you trade futures, I don't have to tell you, they're so leveraged. Even your number's your number. Everyone has a different number, but even a single contract is going to pay you, hundreds, if not thousands of dollars on just gaming those little 1-2% moves in the in the market. And the Nasdaq's more volatile. That's why I usually use NQ over SPY, or ES, I should say. And that's it. So you can look at it and see these periods where the market grinded, not very conducive to anything, active trading or swing trading. So here's the takeaway, guys. Trade your trading style, what's in your wheelhouse, your skill sets. Don't try to be what you're not. Wait for your pitch. That's what I can tell you. I make a lot of sayings up. A lot of the sayings I use, like that one, wait for your pitch, that's not mine. But some of the ones I've made up are, in life, if patience a virtue, in trading it's an absolute necessity. So you've got to wait for the type of setup that is your setup. All right, so I've highlighted levels, that little micro levels we've been playing around on the 15-minute charts, bouncing the cues up and down, up and down, up and down. But the bigger move will come when the longer term, more powerful sell signals, some of the levels I've been watching, the 200-day moving averages, primary uptrend lines. I go over that in all these videos, and I know it's a lot, but you got to mark those levels. Ignore when I say this is a short-term trading setup or something if that's not your wheelhouse. Focus on the the more powerful longer-term sell signals, and we don't have those right now, but they could come quick. That's what I've warned about during Christmas, hitting into the holidays. I'm just marking here as I'm looking at this. That was one bigger divergent low. I can't help myself when I look at a chart. I have many boards. I probably have that marked up. In fact, that's the same 60-minute divergence I showed you on QQQ yesterday. All right, let's move on. Again, that's active trading, not for everybody. And when the charts are conducive and time permitting, that's what I said in my reply. I will share those active trades, but I can tell you on a day where volatility really spikes up, you haven't seen anything yet. This is just, these are just relatively small moves. They're relatively larger than the recent, as I showed you on the daily chart, than other periods where we've been going back and forth. But when you go back to especially if you go back to the previous bear markets or big corrections that we've had, this is nothing. And in those times, it's not uncommon for me to do, and even just the NQs or RTY, if I'm trading that, or ES, a dozen or more trades in a single day, sometimes 20 trades in, out, in, out, in, out, hitting micro levels, bouncing. And then that doesn't even include other things I might be trading, especially if they're related, like the VIX or Treasury bonds. All right, let me move on. I'm going to share trade ideas that I like. Some will be a repeat of other things, but just to kind of big picture it, this is QQQ. There's a trend line off the August 5th lows, broke down, back test. That was that pre-Christmas whipsaw right there I talked about, so take it with a huge grain of salt. And we recently back tested, and now a rejection today. You've heard me say, if you followed me, you've heard me say this before. The thing about shorting a trend line breakdown is that it's quite often quite common to backtest, and then sometimes you backtest for days, sometimes even weeks. You start backtesting, going up, backtesting a trend line, and the problem with that, if you're short trend lines, uptrend lines are by nature, the prices come in higher and higher every day. That's why it's an uptrend line. That's a positive slope to the line, and so you're going underwater. So what I like to see is after a backtest, whether it's the initial or been backtesting for a week, I like to see an impulsive rejection. So that's a pretty good, decent check mark there. But as I've been stating, with these recent lows right here, the 50-day moving average is right there. That recent low should do the trick right there for QQQ. But as of now, this market's kind of doing its grindy, waffly thing. Here's the QQQ. This is that same primary uptrend line off the August 5th lows. there's you can see it's a perfect back test yesterday. So that was, good time to cover, longs off the, taken off that low and or short. And you can see, I think I showed you the 15-minute charts today, but there's that support level. And this was in the videos too. All these levels, sometimes I'll add lines, but I don't think I've added anything here. So that's it. So this market's just kind of doing its thing. There's some distribution, some volatility really. And at the end of the day, it's, bulls haven't won, bears haven't won. But if you take out this trading range, let me show you something else I noticed potentially. Just gives me something I want to cover on SPY. I added a line here today to my SPY chart right here. This is a busy board. Let me clean draw it for you. The lines are there, but let me just turn out everything off and hand draw it in. Potential broadening wedge pattern. I noticed this. This is what I added today to my SPY chart. That downtrend line right there. So you had a little downtrend line, a breakout. You have multiple reactions that make it valid. One from above, 1, 2, 3, 4, and then several from below as well. So that validates that trend line. And then if you go like this, that's a broadening wedge pattern. So a break of that, which again is going to take out, if we take out the recent lows, that would be a sell signal there on that pattern and probably take us back to the 200-day moving averages. So, all right, I'm just going to roll into a lot of miscellaneous trade updates and trade ideas, new ones as well. I got a couple new ones for you here. Yesterday, I told you in the video, it was very clear that it was an objective short entry for NVDA on the back test of the trend line. And so if you took that one, you're up 5% today. We were right there at the highs, back testing the trend line. We have divergence. So there's one of two ways. You could have just taken that reflexive, I'm going to short the back test there, get the quick reaction. This one, I like this longer term. This is one of my favorite long-term shorts. I believe wholeheartedly AI is overhyped and there will be changes. I can sit here and talk for 5-10 minutes on my fundamental thoughts. That doesn't matter because that's not my area of expertise. Sure, I factor it in. Sure, I have a background in doing that, college business degree, business major, former financial advisor, stockbroker, plenty of training on fundamental analysis, how to read a balance sheet and go through the quarterly reports, all that good stuff. But given the two, I put a much higher weighting on technicals, and that's it. So all I can tell you is all of these have, and I've been talking about that for back here. We shortened the video off that bearish engulfing candle divergent high, and I had longer term targets, which I still maintain, but we covered, and including the video. And I was very clear on August 5th, cover all shorts go long. So we gained that bounce, and I've had several shorter term trades, long and short, off NVIDIA since on the 60-minute chart, including this one down to T3, and that's it. So I would look at this as you can do it as a shorter term swing trade or a long term trend trade. Stops are going to be relative to your price target. So again, you need to define your trading style. Are you a short-term active trader? Are you a long-term swing trader? Or maybe both. I wear multiple hats. I have different accounts. And in some, I can't active trade. I can't log into, 6 different, or over a dozen different brokerage accounts at different firms and inner orders and all those. And it's not my goals and objective in some of those accounts, IRAs and things like that. So this is still my final target, still calling for about a 72% drop in NVIDIA. And so therefore, let's just say you agree with that analysis. It meshes with your own. That is, again, this high was about an equal high to that previous one. Marginal doesn't matter. You squint, it's about the same level. So it's the same technical setup. And remember, we hit on August 5th, we hit my first target. So that was the expected bounce. So that's how my trades work. That's why multiple targets are listed. And so therefore, maybe you don't believe NVIDIA is going to drop 72%. I know that's heresy among most bulls and most pundits out there. I feel strong that we'll hit at least T3 in the coming year or so, and that's a 64% drop. So then, if that's your target, or even T2 at 48% drop, you take your price target. So you're talking about 50% drop. You could give yourself if you had even just a 5% stop loss, that's a little too tight in my opinion, especially for NVIDIA. You could do a 10% stop loss, and that'd be an excellent 5-to-1 RR. Very, very good RR. So you could even give yourself better, 12%, 15%. And if you're targeting this level, you can give yourself more. So that's NVIDIA. Just wanted to update it because we did get that rejection off the trend line. So that's the update. Highlighted as a short yesterday. And again, for long term, if you're just trading short term charts, then I'd have to update this. I haven't updated it since back here. But I think where you'll start to see some impulsive selling is when we take out the recent lows right there, if and when. All right, a couple more I'm going to go through in no particular order. Let me do the precious metals first, and actually not the ones you think. I did share GDX as a trade idea recently, a long trade idea off this support level here, divergent low. And so far, it's moving up nice. Gosh, trying to remember if I did on the daily or the 60-minute chart. Either way, we're up nothing big. It's up for GDX, that is 7%. Still looks constructive coming off that divergent low. But the ones I wanted to update for you are palladium and platinum. PALL, if you don't trade the futures, if you do, you already know PA is your symbol there. PL for platinum futures, PA for palladium futures. But if you trade ETFs or ETNs, PALL, that's your go-to one right here. And simple stuff, guys, right? Wash, rinse, repeat. Look for these divergent lows like right here, rally. Look for divergent highs like right here, correction. This is a bullish falling wedge. There's a downtrend line. It's not super well defined, but well enough. It's starting to pop there. Either way, you have the positive divergence. Volume's been tapering off. It was a big, maybe a selling climax here on that move down. Either way, just wanted to share the setup. Oh, and that's... Okay, sorry, paused the video there and I started recording and it didn't take. So I think where I left off is I was going to show you, look for these divergent lows. You get these rallies. This was a bigger divergent low right here, continued to build. You can see my divergence lines, bigger rally. That ended with a divergent high. So watch, rinse, repeat, right? We had the most recent divergent low. Divergence isn't a buy signal, but when you're oversold and you have positive divergence, especially down to support, you can see I've had a support zone around this level right here. And either way, it's starting to pop above there. And that's PALL, palladium ETF. And then PPLT, platinum. You had this same thing here. You can see all these reaction lows here, here, here. We just bounced off there. Positive divergence right there. And you had a little price channel right here, which we just broke out of. So looking good. Wish I would have highlighted it, looked at it yesterday. I've been taking a lot of time off. Not a lot of time, took some days here and there and just kind of getting back into the grind of things this week after the holidays. But either way, we popped that level and that one looks good. And GDX, I believe I already covered. Yes, I did. GDX, I started there. So we already know we're still coming off that divergent low. Let's cover... Let's do Bitcoin. Let me just update that. That was a short trade idea. It still is. Still an active short trade. We hit short it back here. I think on the break of that initial trend line, hit my S1, which means first support level. Bounced, put in kept the divergence going. It's like Treasury bonds. I'm still holding on to my Treasury bonds. They're underwater. But I'm also doing that, as you know. Well, I've been in and out actively active trading, so I can't tell you on that account. Sometimes I'm still along the Treasury bonds, but I'm not actively trading those as much as the NQs. I'll get to that in a second for you. But this is the support level. We hit it back then. We hit it again. We hit it again. That's the magic number. When that level goes, if I thought it was support back then, which I did back in November 26 when I created that line, maybe I updated, I don't know. I moved it. If I thought it was back then, the fact that we had two additional reactions helps to further validate it. So therefore, again, and you can see here we have this little uptrend line, almost a ascending broadening wedge, not quite exactly, but breakdown, back test. And these are still my price targets down there. I still maintain that. And then the sister trade for that, again, it's going to be highly correlated, is MicroStrategies. I gave that to you also as an official trade idea back here, following the bearish engulfing candle. We hit my first price target, which was a trend line. We hit my second price target. I can't remember exactly where the entry. I know it was shortly after the bearish engulfing candle. So we 30%, whatever that gain is so far, and waiting for the next leg down. Remember, I list multiple price targets, because upon the initial tag each one, reaction's likely. That's what we had. And so what you don't want to do is add to that short here. You want to be covering, if anything, and take profits and then recycle back in on a bounce, or just sit tight and, keep your stop. Like any bearish engulfing pattern, the minimum, the stop should be above the top of the bearish engulfing candle, because if it takes that out, that's no longer a topping stick. And so those are still my additional targets. MicroStrategy is almost certainly not going to go to T3 or T4 unless Bitcoin falls. So watch that level on Bitcoin, and just know that if you trade both, then you have an overlap trade. It's just like trading going long NVDA and QQQ or NQ, or going short both. Two different things. Sometimes I'll do that too. I'll wrap a short on the indexes, like on NQ, wrap it up around with my favorites, which lately I've been telling you that some of my favorites in there are Tesla, Netflix, obviously as of yesterday, NVIDIA, to gain some alpha there, to outperform a little bit more. But again, that might be a little much for most people, but it's easy. QQQ is simple, or NQ. You have one single security with tremendous liquidity, and I'm going to add this line right now. It's just a potential downtrend line. Potential, we only have 3 reactions so far, but it's something I'm going to watch. And then also right here, if you wanted to lower stops right now, you have several reactions after that bearish engulfing candle right about here-ish. You can see that. That's it, 1, 2, 3. So really, you don't want to see this one get much above there. It's probably going to want to run at and make a new high. On the short side, another one I still like, I highlighted just before the holidays, Carvana, which did go on to break down below that trend line right here. This is a busy board. It's such a long-term trend line. It comes off 2022 lows back in December 2022, and that's it right there. And you come in there, had a reaction there, and we broke it. And so it's a kickback rally. I don't think you're going to get a back test. It's possible, but this little lift in the last couple days, 2 days, a little short covering. Hindenburg put out a study. Hindenburg is a famous short seller. It's nothing to do with the Hindenburg Omen, but hedge fund, and they're short it, and it's everything I know and a lot of others. This one's cooking the books. This company, I have little doubt. They have a history of it. Looking at this chart compared to the other auto distributors. Dealerships, I should say. This thing is full of a lot of hot air. So, max stop, if you took it, short of the breakdown of the trend line, well, you have to account for a potential back test, and that would be an objective short entry if it gets there. And then 245.76 is also some resistance, more around a zone right there. You really don't want to see it go much above there. It's going to pop and try to make a new high. It won't change the technical posture. This thing has big divergence. You can see it here on the weekly chart. Oh, and there's a clean board right there. There's that trend line. So this is the case to be short Carvana, and these are your targets. This thing, before all said and done, this thing will probably be a 80% gainer especially once the market rolls over for good. Things like this you should vastly outperform, in my opinion, shorting SPY or QQQ or anything like that. Just have to keep your position size small because it's so volatile. Alrighty, what else do I have for you? I should have covered it after NVIDIA, but SMCI is ready for another short, I think, right here. This was one of the targets I had on the way down. We first shorted it actually back here, and then again here. We shorted down. This is a decent, really pretty decent resistance level, 38.20. It was support, support, support. And then when that level gave way, the fact that you had a waterfall sell-off helps to validate it as support. Even though we came through it there a little bit, that's the next resistance level. Remember, support once broken becomes resistance. So you can short it here, just below 38.20. You can also, if it happens to rally up there, even better. And I'll be talking about then, 49.60. You have the 200-day moving averages. You have the red line is the exponential 200-day, and the blue line is the simple. So if it happens to head up there, that would be an additional short entry. So maybe a partial position here, another add to it there, or if the market and or SMCI and NVIDIA rolls over, it's going to somewhat track NVIDIA. Okay, I've shared quite a few longs lately, and again, I've heading into the end of the year, and several times since, I've harped on the benefit of being flexible right now, and stated my preference for trading, when it comes to equities at least. First of all, always diversify among asset classes. That's stocks, bonds, commodities, crypto. Those are different asset classes. That's just kind of investing 101, as well as, in my opinion, swing trading 101. The more different asset class, uncorrelated asset classes you have, you're smoothing out the bumps. If you're only trading Netflix or only trading Bitcoin or even just QQQ, you're going to be very happy some days and very unhappy other days. And it's going to affect your mental psyche. When you're down, you're going to second guess your trade, your position, and probably not stick to your trading plan. So that's where diversification helps. Proper position sizing, all of that good stuff. These guys I've mentioned recently as a long setup. We shorted these back here. I forget exactly where. We had a divergent high and a bearish engulfing candle. Then we had a sell signal there. This and Rocket were monster trades. We hit my first, second, and third target. I told you that I've called this one in. I don't think we're going to get to T4. It is possible. I'm going to get to Treasuries in a second. I think as soon as Treasuries, the charts play out, the divergence is still there. I'm still expecting, still holding on to a long swing trade position in TLT. Man, I think when that breaks out and yields go down, you're going to see these guys pop. You're probably going to see there's a lot of pent up demand for new mortgages, people waiting to buy a house that couldn't once rates went up. Mortgages, obviously, the 10-year bond's been moving up, and so that's not good for these guys. These guys are the, they deal with mortgages. So bullish falling wedge pattern. That's it. All I can tell you, it's a textbook bullish falling wedge. Untriggered, needs a breakout above there. As I told you in, I think it was a few weeks back, that this would be a minimum and preferred swing target right there. And that would be, if we hit it, remember we already made on this thing, going down. If you're still in it, or if you took it down here, 40%, and that would be turn around and make about 14%. Get in, get out. They'll probably run it right up to that T2 level right there. It's nice resistance. And then the other one, which was even a bigger trade, was Rocket. Same thing, bearish engulfing candle, divergent high. We didn't short the high, but from the high, it's already dropped 50%. This company's been cut in half. Why? Because it's going to permeate to the rest of the economy and the stock market. You have my words, these high interest rates will, unless something crazy happens and long-term rates come down. I don't see that happening. We can sit here fundamentally and talk all day long. Biden was a spender and Trump's a spender. And so you can say what you want about each of your candidates, but it's hard to argue that neither of them are anything close to a fiscal conservative. They're the exact opposite. So that's what Treasury bonds are doing. We're in an inflation environment. Crude's going up now because of it. The base metals are looking constructive, things like that. Anywho, Rocket already hit our final target, so that trade's been officially closed out. T5 was hit right there, and it will most likely run along with UWMC that I just covered. There's your downtrend line right there. And if you want to go down, drill down to the 60-minute chart, you've got the positive divergence I like to see. And basically, it's a short covering setup. There's probably imagine a good amount of short interest in this one, and ready to pop. And again, you'll look at it probably double digit gain, probably 15% or so, maybe 20%. If and when that pops. So that's a setup, untriggered. What's it going to take? Treasury bonds, most likely to reverse. So here's IEF. This is the 10-year bond. That's what the mortgage company, the mortgage stocks and mortgages in general care about, and that's what they track. Believe it or not, 30-year mortgages don't track the 30-year Treasury bond. They track closer to the 10-year. And this is the 10-year IEF. Still has that positive divergence. So same case I've been making since right here. We're just grinding around, slightly lower low today, but it doesn't change the technical posture. And it's, and we're talking relatively small, it's only down 1% or so from where it was in the last, the highs last week or so. And that's it. On my zones, those color-coded zones I started giving you in the beginning of 2024, remember, we inched a little deeper into the orange zone, and I talked about that back here. The stock market would really start to take note of rising yields, and it is. You can see the stock market, say what you want about it, it's clearly stalled out recently. Only in hindsight will we know if it's topped, but obviously the market's taking note. I've just started out looking at QQQ. You can see what's happening there. We've been bouncing around and we're off the highs and we've been zigzagging lower. Nothing major. Again, this is an incremental thing. There's two components to this. A function of the level, how deep we go, because remember, this is the bond prices are interest rates in reverse. So the deeper IEF falls, that means more the 10 years dropping in price, higher yields are going. And, I haven't changed this, and maybe I'll tweak this sometime, but this is the same red zone I gave you all the way back here. I changed the zones on February 29th. That's the last time I modified them, tweaked them. But I still maintain that the stock market, if we get there, will start to freak out. And so then what will happen is having a core, still in long-term accounts, core short. We have a short on QQQ since the bearish engulfing candle a few weeks back. And by holding a short against that on Treasury bonds, if this continues to happen, your value of your Treasury bonds are going to go down, but you should be more than offsetting that, in my opinion, in what the stock market will do, especially if we get into the red zone. So those QQQ shorts will start to play off really nice. IWM should do real well as well. Small caps, maybe I'll get to that in a second. And so for the time being, most importantly, we have the positive divergence on the chart, big on the daily chart, on the 60-minute charts. IEF's a 10-year, TLT is the one that I threw out as a trade idea. Still very much have the positive divergence there on the daily chart, still very much on the 60-minute chart. And we just need that reversal to come. And even though I'm longer term bearish on bonds, I do think interest rates, I believe we're in a new secular bull market of rates, higher rates, after finishing a nearly 50-year bear market that ended in when COVID lows in 2020. And I've showed that many times in the past. If you're new to the site, I'll show it to you right now. TYX is the yield on the 30-year bond. You got to go out to the longest time frame I usually do, which is a monthly chart. So think of this. This is outgoing Carter, incoming Reagan right there in the early 80s, right? And that's a secular bear market. This fueled one of the biggest bull markets in history, rightfully so. This is economics 101 or financial markets 101. If you have a background in business or the financial markets, you know that falling rates are bullish for the stock market and the economy for two reasons. Number one, it fuels economic growth. When rates go down, well, the cost of capital is cheaper, so you have more companies and individuals taking out loans to start businesses, expand businesses, build new production plants, buy homes, buy boats, planes, trains, automobiles, all that good stuff, right? Simple. It's very simple. Higher rates are constrictive, raises the cost of capital. Then the other component, and even Greenspan himself said this back in the dot-com period. Oh no, it was Bernanke back in 2008, but other Fed chair heads have said this. It's a well-known fact. The Fed, kept bringing rates down. They figure we can do this forever. Inflation's a thing of the past now. That's something from the 70s, and we figured out the formula. I'm being facetious, obviously. And finally, inflation started to rear its ugly head, and the Fed has lost control, as we know. Now, what I was saying is the other component, besides lower rates spurring economic growth due to lower cost of capital, it's the alternative costs. Think pension funds. Think maybe you're in or close to retirement and you shouldn't have 100% of your portfolio in equity. You shouldn't even have 80 or even 60 or 50% in equities, depending where you're at. You should have more of your money put in secure guaranteed investments such as Treasury bonds, CDs, and fixed income. So the Fed knows, and they've done this, and it's just a simple fact that when you have the lower rates go, the more attractive equities look, because nobody wants to lock their money up for 30 years at 3% or 4% guaranteed. They'll just go out and put it in the stock market and put it into dividend-paying stocks. Think pension funds, which are ginormous. Same thing. They have liabilities that they have to meet. And historically, that's where most of the money was into treasuries, because back then you could get 14%, 15, 16% on treasury, 10%, 7%, 5. And so as rates go up, and again, guys, this is not an overnight thing. The market has been completely dismissive. It had a little reaction when rates started going up. But what I was saying earlier, going back to TLT, I never finished my thought. It's a function of two things. And I've said that back then. It's a function of the level of interest rates. Obviously, everyone knows that. The higher they go, something will break. And it's mostly incremental. There's not a certain level. There could be. They call that, people have been warning of that trigger that we may finally see where the bond market just breaks and lets loose. But again, think of it as incremental. Nobody's going to argue that. I don't think that the higher rates go, the more restrictive it is to the economy, and also gives alternatives to stocks. You might start considering a 7% CD at the bank or an 8% CD or treasury bond, even if you are somewhat, you like risk in your portfolio. The other thing, as I said here, it's a function of the price level as well as the time below the green zone. So in other words, there's that lag effect. So we've had now higher rates, and you can look at it again, TYX, or we'll go to TNX, the 10-year yield. And so we go back, let's go to a daily chart, or let's even go to a weekly. No, we'll go to the daily. Well, there's a weekly. You can see where yields are. So we went up. And again, this is persistent high. Everybody, not everybody, not me, but a lot of folks thought, okay, back here they started already talking about pricing in the Fed easing. But what's happened since the Fed eased? Well, we'll talk about that, and I've covered this many times in the past. The Fed has completely and utterly lost control of the long end of the curve. As I've talked about before, predicted, the charts told me that, after the first rate cut, we were long short bonds, which means we were betting a upward move in rates because the charts said they would go up. Not because I was trying to take some crazy contrarian play. Normally when the Fed cuts, longer term rates will go down as well. But you can see this was the first cut right there. Rates went up. Second cut, rates went up again. And third cut, and rates have continued to go up. So nobody can argue that, and I'm surprised it's not getting more. I know it's been talked about in the media. I'm not the only one that's seen this, but this is big, guys. So, and again, what will happen is, the higher rates go, and again, it's a function of time and level, the more of an impact that's going to sooner or later have on the stock market. And but what'll happen is some point the stock market starts to go down hard, or appears to be, and you'll get that shift into bonds as a safety bid. So at some point here, the technicals are going to play out. You can see TYXC charts still indicate a trend reversal. And so how far, we'll see. I'll address it when it comes. So enough on that. Again, take it, don't take it. It's just one of many, many trade ideas. Like I said, I'm considering it an indirect hedge to a core longer term position, short position on the equity markets at this time. Okay, guys, I'm just going to wrap it up here with the VIX. I've been highlighting the VIX recently as kind of like a hit and run vehicle with a lot of swing trading ops. We look for these divergent lows. We were long there before the breakout there. That was the biggest move in years right there, 372% rally in the VIX. Again, a lot of these divergent lows were highlighted, including this one recently, bullish falling wedge breakout. We hit perfectly the top of that resistance zone. So this is where the VIX will let loose. So again, I started the video by saying if you are looking for a longer term sell signal in the markets or a reason to go long the VIX, it would be this. And this will most likely, this breakout above about the 23.84, we'll call it $24 level, will most likely coincide roughly with a break of the recent lows in the stock market. And if that happens, again, the VIX has been setting up from a longer term perspective. I just jumped from a 60-minute chart that we were looking at. This is out to my weekly chart. This is long-term stuff here. And this is where, I've covered this chart many times in the past, this is where previous bear markets ended at that level. Then came the 2007 to 8 bear that set a new spike, and that we've had two, true bear markets. the one that we had in late 21 and 2022 was a bear market by the old school metric. I think it's still the first wave down and a bigger one. But we had this big divergent low that at an extreme, and that came shortly before. Remember, the market actually peaked here in late '07, so the VIX had already been starting to move up. That's what happens. There was the fourth quarter 2018 drop. So these were, as my notes say here, from 2009 to 2021, where bull market corrections ended. This is where bear markets ended. COVID was 36%, even though it was only 6 weeks. It was a 36% drop, so it was a bear market, and that's what happened during COVID. But then that 2022 bottom in October didn't even make it up to where previous bear markets ended. So what that means, what it tells me, there's just no fear. And so that's one thing this market's lacking. That's that recent, we were long on that one right there, caught that spike there. That ended that correction. Again, that was into the August 5th lows where we covered and then went long. And I just want to point out that we now at this point in time, we're coming off a divergent low and the VIX has been ticking higher. So we still have the potential to do that this year, which I think we'll probably get. But again, I take it day by day, week by week. I've been spewing the long-term bearish, price targets and all that for over a year now, but that's not going to determine how I'm positioned at any one point in time. What determines that for me are largely, to a very large extent, the 60-minute charts and even the daily charts and everything else. And I'll end it here. Here's QQQ, my daily chart, busy board, but there's your primary bull market uptrend line. It comes off the January 2023 lows, nice clean reactions along the way. And when that goes, then you have the 200-day moving averages. And that's it. And then that opens the door to my longer term targets, which I still maintain. And those are, what's that, board 7, 8? Yeah, here it is, board 8, all the way down here to T7. So right now we are on a sell signal following the bearish engulfing candle and then the breakdown of the trend line off the August 5th lows. And so if we take that out, it will still be a divergent high. I'll address it if and when it happens, but as of now, that's what we have. And so this kind of increases the odds that we're going to go down to hit my next targets. Remember, this is just an ongoing longer term trade being, micromanaged, or maybe not as micro, but we hit T2 when we reversed on the August 5th lows. This is just a marginal new and still divergent high. And so that would indicate once we start rolling over, we'll take out the 200s, we'll go down, hit my third price target. And in my opinion, have probably a very little muted reaction there going down to hit T4. But first things first, got to take out the recent lows, and we'll see if and when that happens. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.